Hey everybody, this is Kurt Frankenberg, and I'm joined today by my good friend Mike Chepka, and we're going to be talking about, of course, radioactive trading, the blueprint, and how Power Options supports it. Mike, are you with me on the line?
I believe I am, sir.
Well, super. Okay, I'm having a little bit of technical difficulty. You went ahead and put up your copy, and I appreciate that. Why don't you get us started? I'm going to go ahead and try a little workaround here, and we should probably learn some things about our audience.
Yes, of course. Well, as Kurt mentioned, we're going to be discussing the radioactive trading principles today. We're also going to discuss the end-of-the-year special offer for the blueprint. Of course, we're going to show some of the Power Options tools that are designed specifically for self-directed options investors to help apply these techniques, I should say, in your personal account. And the first thing we always like to do in these presentations is we want to start off and we just want to get to know everyone who's joining us today. And of course the first step is we just want to know, what is your involvement with radioactive trading? Are you just getting started with the free materials? Maybe you've read that free white paper, The Sketch, or you've seen some of the archived presentations or the YouTube videos. Some of you might be thinking about buying the blueprints. The blueprint, of course, is the full work, Kurt's full methodology, where it describes how he sets up his initial positions, in addition to use of the 10 different income methods that we use on top of those initial positions to lower the initial at-risk amount, help bulletproof the positions. Or maybe you already own the blueprint and you're just here to review some of the income methods perhaps, or some of the principles of radioactive trading. And while those answers are coming in, thank you all for participating. I just want to remind you that we do have a question pod where you can feel free to ask questions, but it's usually best to hold your questions until the end of the presentation. The way the presentation is geared is Kurt has sort of factored in already the common questions that come up regarding the technique, regarding the principles of radioactive trading. So it's likely that your question will be answered towards the end of the presentation. However, if it's not, we always leave 10 minutes or so at the end of the presentation to handle all the questions. Well, all right, we've had the poll open for about a minute. Let me go ahead and close that poll, and I'll share the results with everyone. And it looks like we have about 55% of our audience who are taking advantage of the free materials, maybe going through the sketch and the YouTube videos, and 55% of our attendees are thinking about buying the blueprint, investing into this unique methodology to protect your positions. We have 15% who already own the blueprint and are here to review some of the techniques there. All right, fantastic. Let me go ahead and hide those results, and we can just, Kurt's going to go ahead and steal the screen for me, it looks like.
There we are. Okay. Mike, I wasn't able to resolve that one problem, so one of our slides, one or two of our slides is going to look a little funny, but I think our main gist is going to get across, and folks, you're going to want to see this today. It's kind of a big deal. Okay, Mike, can you see where it says how to bulletproof your portfolio?
Yes, sir. You have control of the screen, and we're up and running.
Right. Yay. Okay. All right. Now, I'm going to just do a very, very quick intro. Mike, my name is Kurt Frankenberg. I started radioactive trading in 2002, basically to kind of fight some of the misconceptions and deceptions that are out there with regard to spread trading, cover calls trading, and things like that.
Kurt, you may need to move closer to your microphone there. You sounded like you got very distant there and were very low in volume.
Oh, okay. How's now?
That's good.
It's gooder?
Mm-hmm.
All right. Very good. Anyway, in 2002, I began a blog to talk about my method, which was unique. It was different than anything. And Mike, it was unique enough that when I showed it to you 3 years ago, you said, well, wait a minute. I don't think you can make any money with that. Do you recall that conversation?
Yes, I do.
And what did I tell you, and how did it go from there?
Well, originally when I saw your initial setup, I looked at the position and I said, well, you're going to need the stock to move up 15 to 20% before you realize any profits. I don't see how you're going to make any money. And at that time, of course, you invited me to join your free presentation at that time. It's different from what we're presenting today. And you wanted to show me how exactly you make money with this sort of technique, even though at first it looks like you're adding extra premium into the initial stock purchase position.
That's right. It's counterintuitive, which is a big old word that means doesn't seem right. It didn't seem like the thing to do to a lot of folks, including you. But after a while, you kind of saw that there's some other factors at work, didn't you? I'm going to go ahead and ask our folks here on the line. Okay, when you hear a new idea, okay, and maybe it contradicts or goes against what you've been told before or taught before, what do you normally do? You know, back in 2007, there was a fellow that was blogging and blogging. He is a popular cover calls trading guru, and he was blogging and talking about how you know, puts were not a good idea. You know, you shouldn't add a put to your stock and so forth. And then later he changed his tune and began offering a product that taught how to do married puts along with cover calls trading. And of course, that was a couple of months after he came to my free webinar. so we know where some of the ideas came from. But the fact is, Mike, most folks will rail against this. They'll say, hey, you know, it's not a good idea to do a married put. Okay. What you should do is have a stop order in place. What you should do is you know, sell cover calls and recover a lot of premium and so forth. I'm just curious what kind of folks we have on the line as far as just being open-minded to new ideas. And we've got most of our votes in, so I'm going to go ahead and close and share the results. Nobody said I rejected out of hand. Okay. 39% are suspicious when they hear something that sounds a little new, a little different, but they check everything out. Okay. And to be fair, and then 61% investigate fully. There may be more to be learned. Well, great. Mike, are you happy that you investigated more fully the things that I was teaching 3 years ago?
Yes, I am. I absolutely am.
That's resulted in some pretty good trades, and also it's helped you save your bacon whenever the market's gone against you. So, and you know what? I've learned a lot from you and from Power Options too. So it's a really great relationship. Mike, let me go ahead and hide that poll, and I'm going to make a bold promise to everybody on the webinar. Okay, I'm going to show you a simple truth. It's the principle that all successful traders have said over and over, but they've said it often without the practical directions on how to do it. Okay? Let me see if you, Mike, and maybe, I know that you know this saying, but let's see if some folks on the line know this saying. Cut your losers short, and using your question pod, how about finishing that sentence for me? What's the rest? Cut your losers short. That's supposed to be one of the great keys to trading. Cut your losers short. How about finishing the sentence? There it is. Let your winners run. You cut your losers short and let your winners run. Okay. Now that sounds familiar. Of course it sounds familiar. A lot of folks have heard that. Larry's heard that. He wrote in. Okay. Does it sound familiar? Of course it does. Okay. But there's not very often the practical direction on how to achieve this. Now, Mike, I've got a question. What if you could guarantee that you would always do this? That you would always cut your losers short and always be in a position to allow your winners to run? Would that change the picture? Would that change the way that you trade and the way that you think about your trading? Would it?
I think it would. We don't have to do any special techniques or manage or watch our positions constantly. If there's a way that we could guarantee that, I think it would be overall more beneficial to our bottom line.
That's right. I'm going to promise, and this is a tall order, Mike, but later on within this same program, I'm going to ask you a question, and you'll tell me whether or not I've delivered. Okay, I'm going to do this today. I'm going to show a practical, workable, reliable way to put this vital principle to work and instantly improve your trading results. And if you don't agree, you know, you'll know it right away. Okay. Now that's what I'm giving away for free. Okay. This simple formula is being used in over 25 countries. And Mike, you've seen some of the testimonials, haven't you? We've had a lot of folks write in and say that this free webinar that we're doing, that you and I are doing right now, has done more for them than a weekend seminar about credit spreads or about covered calls or some other intense workshop that's $3,000 or more. So we're giving that away today. Now here's what I'm going to ask in return, okay? This is the top secret principle. It's so important that once you get it, you're going to transform your trading results. But I'm going to ask something in return, okay? Now this isn't an obligation, but at the end of the webinar, I'll be making a special end-of-the-year offer for some products and services that will further enhance your trading. I want you to think about investing in yourself. If you're going to invest in yourself and you're trading for 2011, I want you to think about radioactive trading first. And if I don't show you how to instantly improve your trading results, you know, just ignore me. On the other hand, if I do fulfill the promise in this webinar, you should feel it's only honest to take advantage of my offer. Does that sound fair, folks? Especially since we are, we're fairly priced, we have an ironclad, and we have a risk-free guarantee. Does that sound fair? Gotta tell me. All right, fair enough. We're hearing fair enough. Okay, if it's fair with you, let me know. Okay, Mike, let's review that saying again. How's it go?
Well, we want to let our winners run and cut our losses short, or the reverse. You can say it the other way, too. We want to cut our losers short and then let the winners run.
Right. Okay. Now, Mike, I'm going to examine, in this webinar today, I'm going to examine some different strategies. And there are multiple strategies. I mean, there's credit spreads, there's iron condors, there's all these different types of ways to play options and play stock, okay? And we can't get into every single one, all right? But what I'm going to do is I'm going to suggest that there's actually an option strategy, an underlying basic option strategy that actually practically uses this. It practically puts this to work. Would it be owning stock? Well, it's more about timing the ownership of that stock, right?
Right.
Yeah, so owning stock itself doesn't do it for you. How about selling covered calls, Mike? Can you guarantee yourself to win long term by selling covered calls?
Well, I mean, you can go through phases where, 5, 6, 8 months you're doing very well. You might be making 90 to 95% of your trades are successful and you're getting assigned, but eventually the market's going to turn. And, we hear it all the time, Kurt. I hear people say, well, it doesn't matter if my stock's down 20%. I'm going to keep selling calls and earning my 2 or 3% premium. But if I'm in it for growth, I absolutely care what that bottom line is. I don't want to lose 20% of my investment just because I'm generating income. I want to keep what I started with and be able to grow that. I don't want to have one position set me back 5 or 6 months because there was an unexpected drop or decline in the stock.
That's right. It's about consistency. Albert Einstein had said something about compounding interest being the most powerful force in the universe, at least when it came to finances. Well, how does that compounding work when you actually have a loss in your stock portion of your position? You can collect premiums for a while, but then if that stock goes down enough, it's really not a gain. All right. So how about selling naked puts, Mike? That's completely different from selling covered calls, right?
No, absolutely not. It's pretty much identical to selling an in-the-money covered call. You have the same exact risk-reward profile. You might make, 1.5% to 2.5%, maybe 3% naked yield on the position if the stock does what you expect. But, if the stock drops 15 to 20%, you're still on the hook for that decline. Even if you're using a stop loss, it might get violated with a gap up or a gap down, I should say, in the market. And it has the same risk-reward profile of owning the stock and not really having real insurance on the position.
That's right. This is the risk-reward graph of a covered call, and it's identical to a naked put. Now, Mike, does this go along with that saying of cut your losers short and let your winners run, or is it kind of backwards?
It's backwards. It's opposite to that principle. Don't you think, Kurt?
Yeah, it's almost like it's upside down. You see, what we're doing here is we're cutting our winners short. The market outlook, if you're going to do a covered call trade and try and make short-term returns, short-term money, your market outlook is bullish. You're thinking, hey, the stock's going to go up. And that's evidenced by the fact that you bought the stock. Well, it's a mixed position. It's a hedge position, isn't it, Mike?
Yeah, sure it is. I mean, we're long stock, which means that we're bullish on the position, but at the same time, we've sold a call, which is actually a bearish position, and generated some income. So we have hedged the position, but what we've really done is capped our gains and still kept just about 100% of the risk we had of just owning the stock by itself.
That's right. If you were bullish to begin with, why would you put a ceiling on what you could possibly gain? And at the same time, do you think it's kind of foolish to to put a lot of money into something and have no guarantees about where it may be headed?
Mm-hmm.
Yeah. So this is actually upside down. I've had folks tell me that, hey, cover call selling is just like owning a house and then renting the house out month by month, and it's a reliable monthly income. But Mike, I know real estate investors. I've been a real estate investor myself. I used to work for the largest landowner in Teller County. It's over 200 properties, over 200 income-producing properties. Now, he would never, and I would never, invest in a property that couldn't be insured. That'd be ridiculous. I mean, would you do that?
No,
would
no.
You buy a house that? Go ahead.
Yeah, I was just going to say, it doesn't make any sense to do that. And, everyone tells you, hey, if you're buying a house, you have to have insurance. And as you and I know, Kurt, of course, there are some states where you can't drive a car if you don't have insurance. It's illegal to be on the road if you don't have a form of insurance. Yeah,
in Colorado, if you're caught without insurance, they will take you to jail. That's pretty much it. Okay, and the thing is, the insurance on your assets, okay, that you use to cover your asset, that is available in the stock market. But a lot of folks don't take advantage of it because they think it's unlost. And that's really interesting because those same people will insure their homes, they'll insure their cars, they'll insure their lives, they'll insure their health, but they won't. They'll even buy an extended warranty in a computer, but won't buy a put option. Well, Mike, I've got this crazy idea that we ought to take that risk-reward graph and flip it upside down. If indeed we're bullish on the stock, okay, so we're buying the stock, rather than mixing it with a short call, which is extremely bearish, why don't we mix it with a long put, where we own a put option? And Mike, that does make it safer. But over here in the reward portion, what does it say?
Well, what we're saying now is we're in a safer position that's still bullish, and we have an unlimited reward profile. And what that means, Kurt, is that we're able to enter into a trade where we have the setup already defined for us that follows the axiom that you presented earlier. We can cut our losers short. We have a guaranteed limited risk position and the potential to let our winners run. We have no upside gain. We have nothing capping the upside potential gain.
That's right. Okay, this is an unlimited reward. Let's go back one screen. Okay, we have a limited reward with the mixed position of a covered call, right?
Mm-hmm.
But we have an unlimited position, or I'm sorry, unlimited potential gain with the protective puts, okay? And they're both mixed positions. It's both taking stock and mixing it with the put option, okay? All right. Now, Mike, in 1999, I had gone broke doing covered calls and spread trades, trying to over-leverage myself. Not only was I buying stock, I was also buying it on margin. And I know a lot of folks out there are smart enough not to do that, okay? But I went broke doing it the wrong way. By October 2002, I had begun to mix in the right way, and that's buying stock and also buying a put option to absolutely cap my losses at about 5%. Now, I built up some capital. I got into Yahoo, I got eBay, I got Amazon at $16.09 back in 2002, and they went way up. Amazon, for example, went from $16.09, which is the price I got it, to about $65 in the next 13 months. If I had sold a $17.50 covered call against it, I would have felt like a chump, wouldn't I?
Yeah, you would have been called out, or if you wanted to hold the position and make it continue to grow, you would have had to put more money in the position to cancel your initial obligation.
Right, and that's not really what interested me. But Mike, in the case of having the stock and also the put option, the stock could go up as high as it wanted to. That'd be fine. Mike, here's how radioactive trading got started. I just blogged about it. I wrote about my unique position of buying a stock in an in-the-money put option. And eventually some folks asked me, hey, have you written a book? And I actually took $2,000 worth of orders before I wrote it.
Mm-hmm.
I disclosed that to everyone. I said, look, this is a pre-publication order. I will return your money if I don't get enough orders. But we got over $2,000 worth of orders before I began to write the book itself. Okay, but as I was doing that, Mike, I was with the blogs and so forth. I was giving away a lot free, and I learned very early on that if you give things of great value away free, then amazing things begin to happen. I am going to give some things away free today.
Okay.
And I teach the general strategy twice a week with you, and we also do it in the YouTube videos and a lot of other resources. Okay, but in the last few years, we've had over $500,000 worth of sales of the blueprint and related products. So I believe it makes sense to show folks the value first. Okay, are you ready to show these guys some value?
I believe they're ready for that. Yes, sir.
Okay, very good. First, let's handle the leverage question, okay? All right, let's say we've got a terrible trading record and we lose twice as much as we win. Now, Mike, is it possible to lose twice as much as you win and still make money?
Well, it's very difficult, Kurt, that's for sure, but there are potential ways where you can lose more often than you win and still make money. But losing twice as much as you win and still being able to make money, that'd be kind of difficult.
Well, it all depends on that axiom that we talked about. It all depends on cutting your losers short and letting your winners run. You see, I don't want anybody to start breaking out their calculators. I just want you to go with a kind of a gut instinct, okay? Let's say we're going to have a trading record like this where we lose 5%, which is cutting your losers pretty close, okay? Cutting it short. And then you make 20%, but then you lose 5% again. Would that be preferable? Or would you like to use leverage and maybe, if you lose 40% of your capital, but then you make 160%. Well, look at that, Mike. 160% would be more than double. 100% is doubling your money, so this is nearly tripling your money.
Right.
But then lose 40% again. So I want folks on the line, I don't have a poll question set up for this. Why don't you just ask me or answer me real quick which you think is better, okay? Lose 5, make 20, lose 5 again. Or multiply everything times 8, lose 40, make 160, lose 40 again. It looks like a net there of 80%, doesn't it, Mike?
Now, if I just added up all the numbers, sure.
Yeah, and this looks like a net of 10%. Okay. Somebody says audio gone. I want to make sure that everybody can hear me. Somebody wrote in that audio is gone for them. Okay now, says Larry. Okay, good. All right. Happy day. So do we have any takers? Last time we did this, we had a lot of folks say 5% 20. Others said 40% 160. First one is better, says Joe. Dennis wants to know about biotech. We're not going to talk about that today. Dan wants to do 525. Come on, guys, don't break out your calculators. Give me your gut instinct real quick. Which one sounds better? All right, we've got some folks saying 525. We've got some folks saying 828. Yeah, listen, here's the deal, okay? If you were to play it this way, see, Benjamin wants to go 4160. If you were to play it this way, Benjamin, check this out. This is how the math actually works, okay? If you were to lose 5%, then gain 20, then lose 5%, you'd have a net gain of 8.3. Now, some other time, you can go ahead and work that out on a calculator. But that's the truth, okay? If you had $1,000 and you lost 5%, that'd be 50. And then if you made 20% on your 950 that's left, well, that'd be, what would that be, Mike? That'd be $190, right? And then when you have a 5% loss again, well, geez, your net gain, you're going to have 8.3%. However, if we were to do leverage, if we were to over-leverage ourselves, okay, it could be the same issue, it could be the same stock, but let's say we go with a call option, it's very volatile. If we were to lose 40% on one make 160 on the next and lose 40% of the next one after that, there would be a net loss of 6.4%. Now, I know that some folks say, well, geez, using call options is less, you use less capital.
Mm-hmm.
And Mike, why would you use less capital except for to risk more of your percent of your money?
Right.
When you think of it, what we end up doing is leveraging. If we were to leverage ourselves even more, what about a 50% loss than a 200% gain, tripling your money, then another 50% loss? Well, that ended up with a net loss of over 25%.
Mm-hmm.
Over 25% because we also have commissions to think about. Okay, so let me just ask: is the leverage from trading long calls really a better way to go? I don't know. I don't think so. See, Mike, the lie of leverage is it's important to know that leverage can be used against you too. Mike, my day job, which I actually do at night, my day job is that I'm a black belt in jiu-jitsu, and I teach cage fighters. I teach folks how to get in the cage and mix it up and so forth, and do those that mixed martial arts stuff.
Mm-hmm.
Well, Mike, I don't fear. I've got customers, I've got students that outweigh me by 70 pounds, and I don't fear them. And the reason is because I understand a thing or two about leverage, and I can beat them. But guess what? Once I start teaching them, start training them a little bit, they start understanding some of those principles, then what do you think?
Well, then I think it's more of an even playing field now, isn't it?
Yeah, I give them a little bit of space. I let them fight each other now. Because, I weigh 160. I get a fellow out there that's 230. I can toss him around like a cat playing with a ball of yarn until he understands what I understand. Then it's a different story, okay? Leverage can be used against you. And, Mike, guess what? The market is bigger than you and I.
Absolutely.
And it understands leverage.
Mm-hmm.
That's right. Okay, so folks that argue that a married put is identical to a long call should look into the math. We need to look into it a lot further. Now, Mike, before we do the RPM structure, I want to turn the screen over to you if we could, and look at the trade simulator tool on radioactivetrading.com.
Okay.
So before we do that, and Mike, while you're doing that, I'm going to also take a poll, okay? Real simple poll. We're going to do a before and after. Let's do the before right now. Are you happy with your trading results over the last 12 months? After this exercise, I'm going to pose the question again and see if we have any improvement at all. Okay? But right now, just a real simple question. Are you happy? Are you 100% satisfied with your trading results over the last 12 months? And the market has gone up, and they say that everyone's a genius in a bull market.
Mm-hmm.
That's what they say. But I'm willing to bet that not everybody is as happy as they could be with their trading results. We're going to find that out for sure here in just a moment. Wow. Okay, Mike, I'm going to go ahead and I'll give her another 5 seconds or so for latecomers, and then we'll close her out. Okay? 3, 2, 1, and close. Let me share those results. This almost exactly follows the 80-20 rule, doesn't it, Mike?
Yes, it does.
Now, last week, gosh, we've seen them in the teens. We even saw 7% on one of our poll results. We only had 7% satisfied with their trading results.
Mm-hmm.
Today, we've got 20%. That's actually high. That's pretty good. I'm excited about it. But I'll be more excited a year from today if you answer differently, right? I'm going to congratulate all three groups. First of all, the yeses for beating the market. Congratulations to you. And the fact that they're here, Mike, says something, doesn't it?
Yeah, it says that one of the reasons that we could speculate, of course, and we might be mostly correct in this, but the reason why they're happy is because they continue to do things such as this. They attend free webinars. They do further research. They follow the guideline of the poll you asked earlier. When a new idea is presented to them, they further research and analyze it, and if it doesn't work for them, they might still be able to incorporate some pieces of that into their existing trading record.
That's right. These folks are sharpening the saw all the time, and that's why they're in the 20%.
Mm-hmm.
Now, the 68% that said, no, I'm not going to brag on you, okay, and I'm going to congratulate you too, because you have come to the place to finally do something about that, okay? And the folks said, the 12% that said mixed emotions, I'm going to say congratulations to you too, but for the same reason. The same reason is, look, if you have mixed emotions, that means that you've seen some success, but you've also gotten hurt a little bit by the losses, and that's dragged you down a little bit. I'm going to say that this is actually code for no, because it's easier to say than no, right?
That's right.
And we're not pointing fun, are we, Mike?
No, because we've been in that same situation. Both you and I have had mixed emotions. We've had positions or trading strategies where we were successful maybe the first couple of months or the first few months, and then ended up giving most of our gains back to the market from one unexpected event.
Right. And that's not the way to go long term. Okay. Now, Mike and I have both learned how to cover our losses, to completely cut our losses short and let our winners run. And so we don't have mixed emotions anymore. But anyway, folks, I'm just going to say that you're in the right place. Now, Mike, can I go ahead and turn it over to you?
Sure.
And let's take a look at that trade simulator tool. This is an exercise that you can do on your own.
All right,
folks,
and we're just going to navigate.
You can do on your own.
Yep, we're just going to navigate to radioactivetrading.com, and we're going to click on the Free Resources tab, where there's some free information for you, and we're going to click right on this trade simulator tool. And Kurt, what is this going to do for us?
Well, you know what? It's not. It's not going to project a return. Okay. What we're going to do is we're going to simulate what it's like to be in consecutive trades, because I don't figure anybody here buys one stock, sells one call, and forgets it for the rest of their life. I think pretty much everybody, is involved in serial investing, right? Getting into one position after another. And so this is what you can expect over a period of time. Now, what happens, Mike? Let's go ahead and highlight these. The target return, 10% target. That's a pretty nice goal. Okay, to get a 10% return. Although I know some folks talk about 3% returns or 6% return. 10% is pretty healthy. Okay. Loss limit, 10%. Let's say that if a stock has gone down by 10% or more, we want to bail. Okay. Probability of loss. You know what? Let's say that we don't have a great trading system. And by system, I mean a series of setups, criteria for getting in and getting out. Let's say we're wrong about as much as we're right. Maybe sometimes more often, maybe sometimes less often. But kind of right around a coin flip, okay? And then we'll start with $10,000, and then let's see what happens after 100 trades, okay? So go ahead and let's hit that simulation. So if we do that, we run the simulation. Now, over there on the right, Mike, let me just explain this to everybody. If you could scroll down over on the right. Scroll down and show where it says win, loss, loss, loss. Can you scroll down so that we... Yeah, that's the scroll I'm talking about right there. See, it generates a random sequence of wins and losses 100 times. Okay? All right, now, Mike, let's take a look over on the left side there where it says number of wins and number of losses. Did we lose more often than we won in this instance?
Yes, we had 51 losers on our 100 trades and 49 winners. So we were wrong more often than we were right.
Okay, and let's look at that high value. We might, at one point, mistakenly believe that we've got a winning system, wouldn't we? Because we started with 10,000, now we've got 18,000. So that's what is that, 86% growth there.
Yes.
But on the low value, we're looking at 480, right? And then 4,950 was the ending amount. Well, was that exciting?
No, we're down more than 50% of what we started with. That's not a good way to go.
Not a good way to go. I've got an idea, Mike. Let's just be right more often than we're wrong. Let's run that simulation again and see if we can catch it where, hey, there we go. We were right more often than we were wrong. 55 wins and 45 losses. Well, in this case, we took the $10,000, rolled it all the way up to almost 30,000. Somewhere along the line, we had a low value of 7,100. Okay, so that's a loss of 29%. But our ending amount, we made over 65%. Look at that.
Mm-hmm.
$16,501. Okay, well, Mike, can you predictably be right more often than wrong?
No, I can't control how often I'm going to be right in the market. I don't have that ability. And everyone's always looking for the next new thing or the next new fundamental criteria or technical criteria, I should say, that someone's using that's going to guarantee winners. But that might work again in a short time frame. It might work for that certain market trend. It might work for 2 months or 3 months, but then what happens after that?
Well, as they say, the trend is your friend until the end, when it bends. and we don't want to give back all of our gains. Well, Mike, I've got something really interesting for us to put in there, okay?
All right.
Let's go up to the target return, and let's not increase it. Let's actually lower it. Can we lower our expectations? Is that something that's within our,
Sure.
Can we decide that we'll settle for a little less? Yeah, sure.
Mm-hmm.
Let's make that target return something like 7.5%.
Okay.
Okay, and while we're doing that, let's also make our loss limit say 4%. Now wait a minute, Mike. Is it feasible? Is it possible to have your losses at 4% or less?
Absolutely. We can set up a position so we have a guaranteed exit, and we can set that to be 6%. We could set that to be 5%. We can base it on our own risk threshold.
Right. And Mike, you've looked over my shoulder for 3 years now. You know that my average loss is less than this.
Mm-hmm.
Okay. So let's go. And my average win is actually a little bit more than that. But let's go ahead and run that simulation. See what happens. Okay, well, it's no secret that if we're right more often than we're wrong, we're going to make money. But look how much more money that is, from $10,000 to $95,000. Wow.
Mm-hmm.
Again, this is a simulation, but it's a simulation that uses math. Mike, let's run that thing again and see if we can get more losers than winners. How about that? We've got more losers than winners in this one, correct?
Yes, we only won 49% of the time, and we had 51% losses on the position, or on the record, I'm sorry.
Right. Look at that low value. Is that a real nail biter or what? We started with $10,000. When we got down to $9,511, would we have quit?
Probably not. I mean, that's 5%, isn't it? That's almost commission costs over a course of 6 months or a year.
Right, and over a period of 100 trades, we ended up quadrupling the money. Guys, in case you didn't notice, in case you didn't realize this, math does not behave in a linear manner all the time. What we're looking at here is logarithmic. It's different. You see, that's the way your math really behaves. Mike, let's run that situation one more time.
Mm-hmm.
Okay.
How about that?
And here we've had much more losses. We've had only 46% winners. I'm proud to say that I've actually done a little better than that. I've done a little better than 46% winners.
Mm-hmm.
But Mike, starting with $10,000, looks like we triple our money at the end of that ride. How about that? Okay. In case you didn't see it, folks, I just gave you the secret to success in the stock market. Let me just ask and find out if I'm being too bold by saying that. Mike, we had 20% say, I'm happy with my trading results from the last 12 months.
Right.
68% said no, and 12% said code for no. They said mixed emotions. So that's 80% saying, no, I'm not happy.
Mm-hmm.
Right? Let's pose the question again. If you could keep your wins from last year, but your losses were reduced to, let's just say, 6%, okay? Better than what I just showed, or actually higher than what I just showed.
Right.
If you were able to take all your losses from last year, whatever they were, instead of what they were, make it 6% in that particular trade, would that have changed your trading results? Would you have said yes, I'm happy with my trading results, or still said yes if you said it before? Would you have said no but been closer to yes, or would you have still said no? Wow. Look at how that's shaping up. Mike, I'm going to leave that poll up there for a while to make sure as many folks as possible put in their input. And Mike, when we get back, we're going to see the practical way of how to do that. Okay? That's something else. Okay, Mike, that poll has been up there for nearly a whole minute. I'm going to go ahead and close it. If you haven't done your vote, do it right now. And closed. Share the results. Okay, Mike, we have 61% that would have said, yes, I'm happy with my trading results. Is it me, or is that 3 times as good as what we really have?
Yeah, it's definitely better. It's 3 times better, as you mentioned, Kurt.
Right. 20% were happy with their trading results from last year, but you know what? 61% would be happy if they had only done this one thing. We haven't shown everything, but they've only done this one thing. Now, 26% would have still said no, but been closer to yes, so that's 87% would be doing better if they only practiced this one money management technique, okay? And then 13% would still say no or mixed emotions. Now, folks, I need you to think about this. Does that mean that you lost 5% or less, or does that mean that you don't think that it would have made that big of a difference? Maybe this 13%, I want you guys maybe to go back through your trading records of last year and replace all of the losses with 6% and do the math and see if maybe you'd still come out ahead, okay? But 87% without picking up the calculators, they know it's going to be better, right? All right, Mike, let's go ahead and hide that. And I'm going to take the screen back over, all right?
Okay, sir.
All right. Let me grab that bugger.
And just remember, go ahead and click to show your screen again. There we go.
Okay. So that was an exercise in probability and statistics, okay? And, Mike, the folks that do very well in trading are folks that understand probability and statistics, okay? And what's really good about that is that if you don't know that, if you're not familiar with it, you can be. It doesn't take any more than about a sixth grade background in mathematics. Okay, it's not really that hard, and you can perform this on your own if you want to go to radioactivetrading.com and get to the resources tab. You can check this out on your own. Okay, all right. So I just showed you how to beat the market in 2011, and that's the trade simulator tool on the resources tab on radioactivetrading.com. Okay. Now, Mike, let's go ahead and get into the structure of an RPM, the radioactive profit machine.
Okay.
If we own stock, we want the stock to go up, yes?
Absolutely.
Okay. But if we have a put option in place, in case that stock goes down, we've put kind of a shelf there. We've put kind of a floor to what our losses could be. Now, here's the break-even line, Mike. A lot of folks get scared off by this, and I don't know why. They get scared off by the fact that, hey, you have to make a little bit of an investment, and if you make that little bit of an investment, that means your stock has to go up before you break even. Well, that's not exactly so. You see this gap here, Mike, between where the stock could, the asset, you know, the married put, could end up if the stock goes straight down. The gap between that and break even, this is the maximum amount that's at risk. But Mike, is that maximum amount at risk the moment that you enter the trade?
Well, no. It's not like driving a car off of the lot where we automatically depreciate value of what we invested in. As soon as we open the position, I could turn around and liquidate it and get almost the same price for the stock that I paid, and I might only lose 5 or 10 cents on the put option, just the difference between the bid-ask spread. So when I first open the position, I'm not 15% down, 5% down, 6% at loss automatically. I'm probably in a 0.1 or 0.2% loss when I initially open the position.
Exactly. Okay. So this small amount that you can lose, it's not a guarantee that you're going to lose it. In fact, it's very unlikely that you'll lose that full amount. Okay. I very rarely take the full amount. Now, Mike, I'm going to start out with one of your trades, and I don't think we have time to go through all of what you've done, but at the end I'd like to tell everybody how this trade ended up, dollar-wise. Is that okay?
Okay.
Okay, this is one of Mike's recent trades. Mike got into SLW at $17.20, and at the same time, he picked up a December 2010 $20 put option for $4.30. Well, that looks pretty expensive, Mike. Why would you spend that much on a put option?
Well, I'm following the rules in the blueprint. I did purchase an in-the-money put. This particular put option, as you can see, it's $2.80 above the current stock price. So it's $2.80 in the money.
Okay, so $2.80 is in the money. I see. And the remaining $1.50, that is the time value, correct?
Yes, because I'm buying a December option, as you mentioned. It's May, and I'm buying a December option, so I'm several months out in time.
Right. Okay, so that's like 7 months away. Now, your total invested is $21.50, but you've got a guaranteed exit all the way until December of $20 in case something catastrophic happens.
That's right.
So the amount at risk is the difference, right, or $1.50. Now, Mike, I'm going to go ahead and do the math. Here's the deal. $1.50 divided by $21.50 in the trade equals about 7% risk. You've got 7% of the capital that you put into this trade at risk. Okay.
That's right.
Is it likely that you're going to, I mean, if the stock just heads down starting in May and just goes down and down and down and down, is it likely that you're going to lose that whole 7%?
No, I'll typically only realize that full loss of the $1.50 or the 7% if I hold the position all the way to expiration, all the way to December expiration, and make no adjustments, and the stock is trading below $20. If those three things are satisfied, held it all the way to December, made no other adjustments, and the stock's trading below $20 per share, I'd realize that loss of $1.50. If the stock has an unexpected massive decline for some unexpected reason, let's say it just drops down to $1 per share in the next 24 hours or overnight, then I might be close to that full $1.50 risk as well. But that's an extreme event. Or if those other three things are satisfied, if I hold it all the way out to December expiration. It's the only time I'd really realize the full loss in the position.
Right. Okay, so even in the case of a catastrophe, or if you fell asleep at the wheel and didn't do anything for 7 months, you'd still only lose 7%. Right?
Yes.
Okay. All right, so that's the place where you begin, okay? Now, what I want to do here, Mike, is I just want to compare owning 3 different positions and compare that with our cut your losers short, let your winners run, okay? Let's compare these 3 positions. Straight stock, okay, covered call, which is a hedge on the stock, and a married put, which is also a hedge on the stock. And let's say that in this situation, the stock goes up 20%. Well, how much do we gain with our stock?
Well, yeah, it's going to be 20%.
Right. Now, what do we do with the covered call? We are going to make money, aren't we, if we sell a covered call?
Right.
But we're not going to make as much, are we?
We're going to cap our gains. We saw that before. We're going to sell a call that obligates us to deliver shares of stock, and we might make a 4% or 5% gain if you have here when the position is assigned.
Right. Okay. And when we do the married put, we're going to cut into our profits a little bit, right? I mean, that's fair enough to say. At least if we don't do any adjustments, if we don't do any income methods. But if we strictly own the stock and own a put, that is going to cut into our profits. So let's be fair and let's say that. Okay? All right, so looking at these 3 situations, what seems better? Probably owning stock, right?
Oh, sure. If I knew that the stock was going to go up 20%, and we talked about this last week, if I knew that over a 6-month time period, Silver Wheaton was going to go from $17 to $40 per share, I might have done something differently. But I don't have a crystal ball, Kurt. I don't know what's going to happen 2, 3, 4, even 4 months down the road, or even 2 days down the road. I don't know what's going to happen.
That's right. Now, Mike, let's say that we close all 3 of these trades, okay? Which all 3 of them were gains. All 3 of them were gains. Let's close them and let's invest in a new stock and do something else, okay? We got a problem. The stock is down 20%. Well, how much do we lose with the stock?
Okay, well, we lost 20%.
20%, okay. And with the covered call, well, we would buffer that a little bit because we took in some income, so it's not as bad, right?
Right. I mean, we hedged a little bit.
Yeah. All right, but with the married puts, if we use the married put, and I like to keep my risk around 5 or 6%, okay? And, Mike, if that stock is down 20%, even if I took a 7% risk or 8% risk, I'm probably going to get out at a 5% loss. Can you explain that to me? Why would that happen?
Well, if the stock moves down in price, it moves down 20%. You had purchased a put option, which gives you that floor. And we saw that graph where you have that limited risk on the downside, the unlimited profit potential. So the stock drops 20%. put now goes deeper in the money, of course, but we've put a floor on how much we can lose on that position. We added insurance, which is a guaranteed exit for our stock position.
Well, if my maximum risk was 7% or 8%, why would I only lose 5?
Oh, well, the way that we typically set up the radioactive profit machine, Kurt, is we're buying in-the-money options that are far out in time. So if in the first 30 days our stock dropped 20%, you still might have 4, 5, or 6 months of time value remaining on that option. So you're not going to realize that full 7% loss in the first 30, 60, or maybe even 90 days, even if the stock's down 20 or 30%.
Right. I just want to make it really clear that I'm not fudging numbers here because we showed a 7% risk with your stock just now.
Right.
And I'm saying, well, we'd only lose 5%. Because, honestly, Mike, my losses are usually under 4%.
Exactly.
Okay? When I do lose, even if it's an 8% risk that I take. So, anyway, here's the deal, Mike. If the straight stock makes 20%, the straight stock player makes 20% and then loses 20%, it doesn't sound like a net gain, does it?
Not at all.
It is, in fact, a net loss. Let's do the math real quick. You've got $100, you make a 20% gain. How much do you make?
Well, I'd make, I had $100, so I'd make $20, right?
Yeah. So now you've got $120 to play, and you lose 20%. What's 20% of 120?
Well, now we're looking at roughly, what is that? Not $40. Is it $24?
Yeah, $24 loss. Okay? So if you have a 20% win followed by a 20% loss, it's not flat. That's a 4% net loss. You've got to realize that math does not behave in a linear fashion. Okay?
Right.
Now, how about the covered call? The covered call makes 5%, then loses 15%. I'll just go ahead and skip straight ahead. The net loss ends up being 10.75. Okay? All right. But if we had that married put that made only the 15% when the stock went up 20, okay, but then loses 5% on the next play when the stock goes down 20, okay, then we have a net gain of 9.25%. You see, it was the same market, right?
Yes.
Just different approaches to the same market. One of those, the covered call idea, was cutting your winners short and letting your losers run.
Yes.
One of them was, hey, I just try to see if you saw, I get in, I get out. If you lose 20% and then make 20%, or if you make 20% and then lose 20%, you still have a net loss. People need to understand that. Okay? But here with the married puts, we have skewed our outcome.
In our favor.
Skewed it in our favor, exactly. So we don't get skewed, right? What we've done here is yeah, maybe we've taken a little of the edge off when the stock goes up, maybe a little, okay? But when it goes down, boy, we don't get hurt, do we? And so we end up with a net gain. That's the power, okay, of this saying, which I'm going to hit again. Cut your losers short and let your winners run. Does it fit now? Does that make sense? All right. Well, let's see what's going on here so far. We already did a poll. Okay, we already did this poll where I showed that what is it? 87% would have a happier year last year if they only did this one thing.
Just that one part, yes.
Right, and we haven't even hit the income methods. Let's go ahead and hit the income methods here. We want to have, when we get into the position in the first place, we want to have ideal exposure to the market when we're right. But at the same time, in case of disaster, we rein in those losses tightly, and that's what keeps us in the green so that we can have more to invest later. Right? Now, this particular slide is the one I was trying to fix, Mike, and it wouldn't fix. Okay, ready? Blah! Look at that. All right, but see, this small amount that we risk in the first place, you can only lose that much if you do three things. Number one, you hold all the way till expiration. Number two, you make no adjustments. Number three, the stock takes. Okay, and we're going to try and pick good stocks, but if we're wrong, we do lose a small amount. Okay, if we make no adjustments, and if we hold all the way until expiration, well, we're in charge of making adjustments, right? I mean, we can decide to or not to.
That's right.
We can also decide to or not to hold that stock all the way till expiration, so we're really in control. That's kind of cool.
Mm-hmm.
But Mike, now we're going to talk about the income methods, and I call them income methods because they're almost always normally with credit. Okay?
Except for some of the ones I do.
Oh, okay, yeah, that's right. There are some ways to do it differently if you want to. But Mike, here you got into silver Wheaton, okay, on May 21st.
Mm-hmm.
And you never had any more than 7% risk in the position, right?
That's exactly right.
Now, about a month later, June 28th, here's what happens. You used income method number 1, which is there's no secret to it.
Mm-hmm.
It's selling a near-term covered call. Now we have 10 different income methods, but this one income method, your total amount invested had been $21.50, right? With
Yeah,
the stock and
$17.20 in the stock, and then $4.30 for that December put option.
Okay, so your total commitment to this idea here is $21.50.
Mm-hmm.
Now, when you sold the August, I remember that it's a December put option that you're using to take care of you.
That's right. Yep, we were out to December, and we're on June 28th, and I was able to sell the August 21 call for $1.48. And to be honest, I'd put in a market order to try to get it for $1.50, and it never filled. I lowered it, and then it just triggered at $1.48.
Got it. Okay, so what that did was that lowered your cost basis, right, for the whole position, for the stock and the put.
That's right. Out of pocket now between the stock purchase price, the put purchase price, and the new premium I received, we've got a cost basis of $20.02.
Okay, and then so you still have a put option that's at a $20 strike.
That's
so
right.
Mike, if the stock tanks and goes straight to hell in a handbasket, okay, how much could you possibly lose?
Right now, I'd only be losing 2 cents. If the stock just plummeted at this point, that call would essentially go to zero. I still have a guaranteed exit of $20, so I'm only going to lose 2 cents on the position, which works out to be $2 for 100 shares.
Now, Mike, you did this with 300 shares, so
Yes.
let's be honest. You could have lost $6 whole.
$6. Yep.
Okay. All right. Now, without boring anybody with the details, I mean, it's not boring. It's actually a really exciting ride. But without getting into all the details, I'm going to say that, Mike, this is not the only income method that you did, correct?
No, I used income method number 1 again later, but I was able to do income method number 4 a few times as the stock continued to move up in price.
Right. Now, the purpose of the income methods is always to put yourself in a slightly better position than where you started. It's also a hedge.
Mm-hmm.
The income methods reduce the gap. They reduce what you could possibly lose. In this case, you reduce it down to 2 cents a share, right?
Exactly.
All right, and then after you did income method number 4, the very first time, you were bulletproof.
Mm-hmm.
What's bulletproof mean?
It means that I now have lowered that cost basis again, or what I did with income method number 4, of course, is I adjusted my insurance policy. But whatever income method you choose to use, you end up at a position where your total cost into the position is actually lower than the guaranteed exit. It's lower than the strike price of the put option that you have. So you can't lose on the position, even if the stock goes to hell in a handbasket, as you said, and you still potentially have an unlimited upside profit potential.
Right. Okay. So at this point, we would be bulletproof. Bulletproof is a nice way to sleep at night, isn't it?
Absolutely. Mm-hmm.
Okay. Now, let's see. We've got just a few more minutes, and I did want to show something else for free, okay, to our attendees, and it's right at 11 o'clock my time. It's right at 1 o'clock your time.
Correct, sir.
We've only got a few minutes. We usually go 15 minutes past, okay? But I'm going to say it's up to you, okay? And this shouldn't have spread out like that. But Mike, what do our viewers want to see? They want to see the bulletproof vest, which is what I put on before an earnings announcement.
Mm-hmm.
Would you like to see the ATM machine, which is how we make a small deposit and then we expect more in the future, which you can do if you have an interest-bearing account, right? Okay.
That's right.
Just wait till you see how Mike applied it. The MoneyNet one, which will collect more income than a covered call if things go your way. Or the MoneyNet 2, which leaves the upside open while it takes income. Okay? So I'm just going to leave that open. I'm going to see who wants to see what, and then we'll make a decision, and then we'll go ahead and share that. Okay? So who's into it? Dennis wants to see the ATM machine.
Oh,
Patrick wants to see the vest.
Right.
Go ahead.
Yeah, I was just going to say the same thing you were saying.
Yeah. Not sure what Joe's talking about there. Okay, Larry wants to see the ATM machine. Mike, would you like to show the ATM machine?
We can do
Or
that.
should, yeah, or should I? I mean, I could pull it up too. Let's do it.
Yeah, it's up to you.
You know, I'll go ahead and show my example, which is actually very.
It's very mathematically simple.
Yeah, exactly. It's easy for folks to see that one, I think. And
well, Benjamin wrote in real quick, and he said he's completely lost. What Kurt's referring to here, Ben, is these are all income methods. What we've been talking about today is the unique principle being able to limit your risk and still have unlimited upside, and the benefits of doing that in the market. That's the starting point for any radioactive profit machine. Once we have that initial married put setup, the blueprint further discusses the 10 different income methods you can use to lower that risk and potentially bulletproof the position. Now, those 4 things that Kurt had up there that he was asking, what would you like to see, the bulletproof vest or the ATM machine, for example, what those were referring to are different income methods. Those were 4 of the 10 income methods that we use that are described in the blueprint to lower that risk and bulletproof the positions. And we're going to use what's called the ATM machine, which is income method number 4. And I believe Kurt's pulling up his DIA example from a few years back.
Right. I'm having some trouble getting it up. Let me go ahead and run another poll here real quick. I put up the poll results that said if you could keep your wins from last year, but your losses were 6% or less, would you have answered differently? Well, let me ask how much. By how much? And hopefully I can get this bugger opened here. Okay. Yeah. Okay. I see what I have to do. Pardon me, gang, while I pretend I know what I'm doing. All right. And we're filling in that poll very quickly. Mike, these are surprising results. Do you see that?
I do.
That's really something else. Okay. Okay, let's open that up and let's discuss that. And then I'll go ahead and show income method number 4, which we call the ATM machine. Okay. Which may not happen. Are you hearing that beep beep thing?
I'm hearing something, yes. I'm not sure exactly what it is. Give me one moment.
You know, maybe you could actually pull that bugger up. Apologize, ladies and gents. I'm having difficulty with my PC, which I hate. I love my Mac. It works every time. You know, all you have to do is turn it on, turn it off. It works real well. But Mike, let me go ahead and share these poll results here.
Okay.
Okay. 0% said that it couldn't. I don't see how that could help. Okay. 17% said I would have saved at least $300 on my worst trade last year. Okay, or one of my trades last year. 11% would be ahead by $1,000 to nearly $5,000, and 56%, Mike, 56% would have saved or made $5,000 or more. That's from what we showed you here today for free. Now I hope that invests in you a sense of what you should do over the next year. I mean, if I ask the same question a year from today, what's the answer going to be? I'm happy with my trading results, or I'm not happy with my trading results. Okay. All right. Mike, did you find that bugger so that I can share?
I'm looking for it. Hold on one second. I apologize,
Okay.
Kurt. It caught me off guard, and I have it hidden somewhere, and I'm not sure on which presentation of yours I have that available.
Okay.
So just give me one second.
That's fine.
I have a different form of it, but it's still that DIA example. It's not the one that has your assets and risks on it. But I have one from the the seminar that we did on income method number 3 and 4.
Okay, great. Yeah, we could share it that way. And in the meantime, I'm going to go ahead and run this this poll here about education. Okay, about education in trading, education in option strategies, things like that. Nobody so far has told me that it's cost them nothing. You know what, folks? Ignore that final answer, that last answer, where it says income methods that work better in sideways market. Just ignore that. That doesn't belong there. So I just wanted to see what you've spent for your education. Has it been free? Has it been double-digit range? You know, between 10 and 99. Has it been triple-digit range, between $100 and $999, or has it been closer to, you know, 4-digit range? Is it, you know, $1,000 or $5,000? What is it closer to? Okay. Just a question. Okay, 12%, their education's been free, 18% double-digit range, 35%. Most folks have done $500 or thereabouts, but nearly a third have done about $5,000 or close to it, okay? So essentially, for that third, for that 29% anyway, what I've shown, I think, has probably been worth about $10,000 to them. Do you think that that's outlandish for me to say, Mike? Or do you
No, I don't think at all, Kurt. I don't think that's outlandish at all.
Yeah. Okay. All right. We are going to show the ATM machine once we get it figured out. Mike, are you ready? Or
Yeah.
You are?
I think so.
Let me go ahead. Let me make you the presenter, and this is what we wanted to do as a bonus, and then we're going to give you the offer, and I'll let you go, okay? All right, Mike, income method number 4, rolling up the put. Let's go ahead and take a look at how that's set up. This is a classic example. Now, Mike, you just finished with your SLW example. How did that work out for you? I mean, you were bulletproof about a month in using income method 1, but then you used income method 4 repetitively.
Yeah, I used it in September, and I used it again at I used it in the beginning of September and at the end of September, and I believe I did it again in October, and then the last income method number 4 I did in beginning of November. And what that did to the position at the time is that I had a guaranteed exit, a guaranteed gain of 22.9% after that last income method number 4 on November, I think it was November 4th actually when I made that trade. So I was guaranteed a return of 22.9%, but I still had an unlimited upside. Now if I liquidated at that point, I would have made about 43, 42%. That 22.9% guarantee, I would realize that only if the stock tanked. So the end of the position when I decided to close it in December there was a 59.8% return, but at one point I was guaranteed an exit of at least 22.9% if the worst case scenario happened.
Okay, so if something really bad happened, you'd only make 22.9%.
Right.
And because you closed it 2 weeks ago today, correct?
Roughly, yes, that's right. That's exactly right, yes.
With a 59.8% return.
So
let's go ahead and take a look at how that happens, okay? Mike, I'm going to show the DIA setup. Mike, I posted this on a Yahoo Groups forum where some folks were bad-mouthing married puts. And I said, okay, well, let's just take a look at this. And I got into shares of DIA. This is the actual trade that I did, and I posted it. And later on, the person that moderates that forum decided to have me join him. And we've done some joint projects together. It's kind of interesting. But I picked up shares of DIA at 115, and at the same time, a 4-month out in time put option at the $119 strike price for $5. So that makes my total investment there of 120, okay, per share. But I've got a guaranteed return of 119. So the amount at risk is the dollar difference. Now, Mike, coincidentally, if you go up and you look at that put option, how much is it in the money?
Well, the stock's at 115, and you're looking at a 119 put, so you have $4 of intrinsic value. You're $4 in the money, Kurt.
Okay, and so the dollar that remains is the time value,
Mm-hmm.
right? And that's exactly what's at risk. Now, we're going to see a really incredible phenomenon here at work. Let's go to the next page.
Sure.
Okay? The income methods are responsible with the market's already done, right?
Mm-hmm.
Rather than doing it, I'll tell you that this is a spread trade, but rather than doing a spread trade, anticipating what the market may do, it's something that I'm doing after the market has moved. That's the way we like to think here.
Mm-hmm.
Okay, and so let's go next frame. Okay, the first goal is to eliminate risk, and we're going to bulletproof ourselves here.
Yes.
After that, there are certain income methods that can enhance your returns, like income method number 5 and 6, the money methods.
Mm-hmm.
Here's what happened, Mike. 24 days after I had set it up, I bought to open a January 08 $128 put option and sold to close my January 07 $119 put. Now, wait a minute. Is this a credit or a debit?
Well, this is a debit. You're going to pay another $9.70 into the position, but you're going to get $2.05 back. So you're going to increase your cost basis with this particular income method, and here you increased your cost basis $7.65.
Okay, so let's go next frame.
Mm-hmm. Oops, I'm sorry. There we go. How about that?
Okay. Well, that doesn't sound like an income method, but let's look at what's happened, okay?
Mm-hmm.
At the beginning, I had shares at $115 and the put option at $5. Total investment so far is $120. And if we add in the cost of that spread, it's $765. So my new total investments, what I got into the trade is $127.65. Okay, next frame.
Wait a minute. You
See,
changed the
new
strike.
guaranteed return.
Mm-hmm.
Go ahead, say again.
Yeah, you changed the strike price of the put. You adjusted it, and so now you do have more invested in the position, but you have a guaranteed exit of $128 now.
That's right. I had a put option at 119 strike. Now I've got a put option at 128 strike, and the most that I've spent so far has been 127.65. So at this point, Mike, how much risk do I have?
You have negative 35 cents at risk. You're guaranteed a return of 35 cents on the position no matter what happens, but you still have an unlimited upside.
Right. You see, if the worst possible thing happened, I'd still be all right. Let's go to the next one. Now, Mike, everything that I've done is in that little blue circle way over to the left.
That's right. This is when you did income method number 4.
Buying the stock and put in the first place, and then rolling and put after that. Okay. Now, after that, guess what, Mike? Not only did I make myself bulletproof, but I also increased my holding time from 3 months to 15 months.
Right, because you bought the 08 put now, right, to the 128.08 strike put.
Right. And you can see that roller coaster right up there. I could be using income methods 5 and 6 to capture more, up and down. And so that's a really happy thing. And did I forget to mention that DIA pays a dividend? In
Absolutely.
fact, this time, it was a monthly dividend. Okay, so I've got no risk at all and the ability to continue to play it with the income methods for more. Let's go next frame, see if there's anything valuable on that one. Now let's forget it. Okay, good. That's all I wanted to mention there, folks. So let me go ahead and take that screen back.
Go ahead, sir.
And shabadoo. All right, I am now the presenter, and I need to show my screen.
There you go. Go ahead and show your screen, and we are all set.
Okay, let's go ahead and review the offer. Okay, that I mentioned at the beginning that we're going to do. Now, the offer contains 3 components. Okay, number 1, what you get. Number 2, what it's going to cost. Number 3, what you risk. All right, we have 55% of our folks on the line. We're looking at buying the blueprints. Okay, here's what you get. The blueprint has over 250 pages of instruction on limited risk, high potential return trading. I don't want you to be daunted by that. The first 3 chapters is going to contain stuff that is going to catapult your trading much higher, okay? And then after that, if you want to continue to enhance and grow, then there's more. And it's not like we try and rope you in, and, oh, you got to go to this master level course, you got to go to this thing and that thing. You know what? It's all 10 income method adjustments of the radioactive trading method are in the blueprint. Okay. Now today we've got this end of year. Today until December 31st, we've got this midnight. We've got this special offer. Okay. There's a quick action guide PDF that comes out to you about how to get started quickly trading radioactively. Okay. The Foundations of Radioactive Trading CD, which we normally sell for $89, we're going to package that along with the blueprint. And it's going to teach you about how to trade a portfolio radioactively. Not just enter one trade or another, but how to convert your existing positions and take your, know how much to allocate to what position. And that in itself is a science, okay? And so that's something that's kind of above and beyond the blueprint, but it's actually very understandable and concise. Okay? 2 free months of Power Options. Power Options software is what I use to select, to find these kinds of trades, and also what I use to evaluate an adjustment before I make it. Before I do an income method, over there in my Power Options portfolio, it might say, hey, your stock is up a little bit. You might consider income method 1. You might consider income method 4. And then I can click on those and find out what my before-after picture looks like before I even do it. And the numbers have already been crunched. It's amazing. Okay, you get 2 free months of that along with the blueprint. Okay, and that's only what we're doing until the end of the year. Okay, it's $289 for the blueprint. Now, Mike, here's one reason why I threw this poll up there. What would you say your cost has been? Right.
That's right.
And this other poll here. Whoops. Hang on. This other poll here. How much better would you have done if you had only followed the money management portion of what we shared?
What we gave away for free.
What we gave away for free. 17% would have made that $300 right now. Okay, 11% be ahead by 1,000 to 5,000. The lion's share would have made $5,000 or more. And some folks recognize the potential, the fact that, if all your risk is 6%, well, when the market bottoms and you have 94 of your marbles to still trade, boy, you can do pretty well. Okay, so anyway, this is what it costs. All right, we said what you get, what it costs, and what you risk. Now, Mike, what if that $289 investment were a married put? What if it was a married put?
Okay, so you've got risk of $289 and unlimited upside to help grow your portfolio.
That's right. Okay, but see, the guarantee takes out all the risk. All right, and here's another one of the slides I was trying to fix. Okay, it's 100% guarantee. All right, but that 100% guarantee takes away the risk from you and puts it on us. Okay, if you don't think that the blueprint is going to do for you what we said that it would, after you get it and after you review it, then return it. Okay, takes out all the risk. Okay, so that's the offer. It's what you get, what you pay for, and what you risk. You don't have anything at risk. All right. And you can keep those bonuses. Check out Power Options. It's still the best offer in the world for the other 22 strategies that you support. Right, Mike?
That's right. Yes.
All right. And okay, so there's the deal. You get the blueprint. You get the quick action guide. Foundations and Radioactive Trading CD, 2 months of Power Options, and it's $289 for the whole deal. And none of your $289 is actually at risk. Now, I'll tell you what. If you read the first 3 chapters and you don't feel like I've given you the means to pay for the whole purchase price, I demand that you send it back. I don't know how much better to put an ironclad guarantee on that. All right, and here's what you risk if you don't handle this today. Okay, this is the lowest price that the blueprint will ever be offered. I've done price testing. We've done a lot of different things. I sold earlier versions of the blueprint. Mike, I've actually gotten $389 for earlier versions of the blueprint.
Right.
We priced it much lower than that to make it accessible to folks. But just market demands and pressures and so forth, we're making this the lowest that it's ever going to be offered. In 2011, the price for the blueprint is going up significantly. Okay, so there's that. Okay, Mike, I think we're toward the end here. Do we have any questions that came in that we should maybe answer for the whole group?
Well, Benjamin wanted to know what is the blueprint. Well, what we've shown you today, Benjamin, is about 1/50th, 1/15 of the entire radioactive trading method. We shared with you the setup, buying the stock and buying the put. But we didn't talk about what kind of stock Kurt likes to look for, the specifics of how you set up that put option. So we gave you a little bit just to show you how it works, but we didn't discuss the specifics. We showed you an example of income method number 1 on silver wheaton and on income method number 4 on DIA, but we didn't go through the processes of how would I have decided to do income method number 1 or income method number 4, and then of course there's 10 different income methods. Now, is it a course or is it a method? Benjamin, it's really not either. It's more of a method, but it's not a strict set of rules. It's not always do this, always buy these stocks, always trade this income method if this happens. It's an overlay to what you might already be doing. I use the radioactive trading techniques in my personal account, but because of my account size and the way that I trade, I use different stocks than Kurt does. I'm still having the limited risk in place, and I'm still able to take advantage of the 10 different income methods, but I'm trading different stocks than Kurt is. Our customers might trade different stocks, for example. Now, one of the bonuses, of course, that comes along with the purchase of the blueprint before the end of the year special is you can follow over Kurt's shoulder with a Fission subscription for the first 30 days for only $10. You get a discounted access to watch Kurt and go through his previous trades in his account using these techniques. So you can follow him. You don't want to use that as an advisory service. It's more of a learning service to see how someone who created the techniques uses it in his own personal account.
That's right. Mike, we ran out of time today, but maybe on Thursday or Tuesday next week.
Tuesday next week.
Tuesday next week. Yeah, we're not doing things on Thursday? Okay.
Yep.
Merry holidays.
That's right, yes. Mm-hmm.
Very good. Okay, other questions? One of the things I want to really emphasize about radioactive trading is it's not a whole new set of signals to get in and get out. It's not a whole new set of things to consider for fundamentals. What it is, it's an overlay on what you're doing already. Mm-hmm. You see, we asked the question, what if you were able to keep your wins from last year, but
keep your losses down to 6% or less?
Yeah, if there were 6% or less, would that have changed your outlook? And without knowing what kinds of stocks you traded, and without knowing what kind of timing you use, and what kind of hold time horizon, or your entries and your exits, I didn't know any of that stuff. All I knew was, hey, I've got a method for you to reduce your losses and to absolutely control them. And what would that have done to your bottom line? Mm-hmm. Okay, so that's what the blueprint's all about, along with the 10 income method adjustments that are done either to guarantee a higher return or they're done at the credit. Okay, did we have other questions there, Mike, or shall we finish this one up?
No, I think we've got everything covered. If you do have questions later, you can call the office, of course, or just send us an email to support@radioactivetrading.com.
Very good. Okay, so Mike, I'll see you in a week, and folks out there, I hope that you pick up the blueprint before then, because time's running out. Mm-hmm. All right, Mike, you're the best, and folks, thanks for coming. You're the best as well. We'll see you out there. Happy trading.
Man, happy holidays, everyone. We'll see you next Tuesday.
Very good. All right, bye-bye now.